another class. Today, we're going to move forward from where we stopped on group account. We have moved to a good extent. We stopped at this question in the last class. And what I've tried to achieve with you on group account is to make you understand the fact that when one company invests in another through equity instruments, it usually results in different types of investment. And the investor would either have an investment in subsidiary or an investment in associates or a simple investment. We have taken our time to look at investment in subsidiary because this type of investment arise where an investor buys equity interests in an investee and his holding in that investee is above 50%. And particularly, more importantly, is where this investment gives the investor control over the investee. The key determinant of investment in subsidiary is control. As soon as you have control over another entity, then you should consolidate. IFRS 10 and IFRS 3 requires that you prepare a consolidated financial statement. And I made you understand that the indicator of control is not just holding above 50%. It could be if you have the power to fire, to hire key management personnel within the entity. If you have the power to direct the entity to enter into contracts in your own favor, you have control. You do have control. If you can direct the relevant activities, how they spend their money, if you are the one making such decision, you have control. And the accounting treatment is nothing beyond that. You have to prepare consolidated financial statement. In fact, you must. In that, when you have a subsidiary, you cannot avoid to prepare consolidated unless you lose that control or you yourself have a parent that prepares consolidated financial statement. That is where you are exempted from preparing consolidated financial statement, or where you are not a listed company or you are not in the process of listing. And preparing consolidated financial statement is so straightforward that all we are doing is just trying to prepare the financial statements of the parent and its subsidiaries as that of a single economic unit. To achieve single economic units, what we are saying is that when we look at your profits, when we look at the consolidated profits, that consolidated profits should be the profit you have made from transacting with outsiders, from transacting with other businesses, not with your investee, not with your subsidiary. When we look at the money you have made, it should be the money you have made from transacting business with outsiders, not between the members of the group. And that is why the hallmark of preparing consolidated financial statements lies on the principle of cancellation. It's nothing beyond that. That where there are transactions between the members of the group, that is, the parent and its subsidiaries, you cancel them out. When they are trading within them, you don't consolidate and you don't reflect that in the consolidated financial statement because that would defeat showing showing their accounts together as a single economic unit. So you don't consolidate all that. And we follow that to the letter. And we looked at this question. This question really helped us put together a lot of things that we have learned from understanding the fact that pre-acquisition retained earnings are usually cancelled out. You don't consolidate them, you remove them on cancellation. And also, where there are deferred consideration, you would usually discount those ones to present value when you want to use it to cancel out against the equity of the subsidiary. You discount it to present value. And of course, there will be another leg, which is a liability because you haven't paid it. And that other leg that is a liability would be increasing every year through unwinding of discounts by recognizing a finance cost. We also looked at a scenario where the parent buys a brand that it values itself. We saw that that would also be recognized as an intangible asset in a consolidated account and also a reserve, but a pre-acquisition reserve that would be recognized in the books of the subsidiary. Because it is pre, it would also be cancelled out because it's part of what the parent has paid for. Basically, this taught us all of that. And the issues around non-controlling interests, we learned that when the parent does not own the subsidiary fully, it therefore means that there are other owners of the subsidiary which we call non-controlling interests. These non-controlling interests also, they are consolidated because it's transactions with other people that we need to reflect in the consolidated account. And the parent has the option of valuing this NCI either at proportionate share of the subsidiary's net asset, where it values the NCI by taking a percentage of the NCI on the net asset of the subsidiary, or it measures the NCI at fair value by looking at the share price of the subsidiary and multiplying it by the number of shares acquired by the non-controlling interest. You can use that as a basis for determining NCI. And the impact of that is that when NCI is measured at proportionate share of subsidiaries' net asset, it means that the NCI will not have a share of the goodwill because it's going to be in and out. But where the NCI is measured at fair value, it means that the NCI will have a share of the goodwill. And where that is really reflected is where there is an impairment of goodwill. Where goodwill is impaired and NCI is measured at fair value, the NCI will also suffer part of the impairment loss. And that is why you will see us removing that impairment loss from the retained earnings of the subsidiary, just so that it will reduce what the NCI and the parents are sharing, but by that impairment loss. So they both suffer it. But if NCI is measured at proportionate share, the impairment loss will be fully suffered by the parent, in that the impairment loss will be deducted from the retained earnings of the parent. We explained all of that last week. Now, we are still going to continue with that, but we are going to look at some other types of transactions that are cancelled out. We have majorly focused on canceling out transactions that has to do with investment within the subsidiary in the books of the parent that is being cancelled out against the equity or net asset of the subsidiary. And that was what was resulting into goodwill, into things like gain on bargain purchase, into impairment of goodwill, and all of that. Now we want to look at what if there are further transactions like sales of goods between the parent and the subsidiary, or sales of non-current asset between the parent and the subsidiary. Let's see how. Okay, now let's look at this question. It says Pico has owned 75% of the shares of ESCO since the incorporation of ESCO. During the year to 31st December 2017, ESCO sold goods costing 8,000 to Pico at a price of 10,000, and these goods were still unsold by Pico at the end of the year. The statement of financial position of the two companies on 31st December 2017 are given below. So we're given the statement of financial position of the two companies. We are now asked to prepare the consolidated statement of financial position of Pico at 31st December 2017. The fair value of NCI at acquisition was valued at 12,500. So you will see here that the major thing here is that ESCO, the subsidiary, sold goods to the parent. Goods that was costing 8,000. He sold it to the parent at the price of 10,000. And these goods were still unsold by Pico at the end of the year. That's the new thing here. And as you would know it, whenever there is transactions between the parent and the subsidiary, it has to be cancelled out. Now, I need you to really understand what we are cancelling out in this case. You know that when ESCO sells goods to the parent, it's not going to reflect in the statement of financial position. And what I'm still teaching you is consolidated statement of financial position. It's not going to reflect. So what do we then want to cancel out here? Who can tell me? What can we cancel out here? Can anybody figure that out? What in this transaction will reflect in the statement of financial position? Okay, Olalekan.
Yes, I guess since Pico is here to sell the goods, so we should have closing stock of Pico in the consolidated financial statement. Yes. Closing stock at the end of the period.
Closing stock at the end of the period of Pico. That's what will be in the statement of financial. Okay, nice one, Lekon. Nice one. Okay, is that the only one? Okay, let me hear from Balkis.
I think we'll be cancelling out inventory.
To be cancelling out inventory. Okay, similar to what Lekon has said. Inventory. Okay, nice one. But is that the only item that we can cancel out? Because if you just cancel out inventory of how much now? Because if you are canceling out, you must be canceling out one against the other. Okay, let me hear from Shidima.
We're also going to consider the unrealized profits.
We are going to consider the profits, the unrealized
profits. Yes, sir.
Okay, would that be showing in the statement of financial position? Would that be showing in the statement of financial position? Because here we are considering statement of financial position.
No, sir.
Okay, then that means it will not impact here. Okay, yeah, let me hear you about case.
Okay, so would cancel out inventory of Pico, then we'll remove from the retained earnings of ESCO.
From the retained earnings of ESCO. Okay. All right. Nice one. Nice one. Nice one. Okay. Michael, let me hear from you.
So for me, I think first of all, intercompany adjustment, since it's a sales, so we only recognize the revenue of this amount. We only recognize the revenue of PICO and we'll back it out from the cost of sales of ESCO.
Okay, but we are not doing consolidated statement of profit or loss. We are doing consolidated statement of financial position. So that will not fly here. So my question was, in this transaction of ESCO selling goods to PICO, which one would appear in the statement of financial position of either of them? Okay, so Lekon and Balkis, you came really close to it, all right? And Michael was speaking to statement of profit or loss. So actually, when we get to statement of profit or loss, you would see this type of adjustments too. And you see that when they sell goods to one another, the revenue that has been recognized in the books of the seller and the purchases that have been recognized in the books of the buyer has to be cancelled out. The both needs to go out. However, in the statement of financial position, those will not appear. What would appear in the statement of financial position first is the profit that is being made. Okay, I think, hey, Michael, do you want to say something? Okay, so what will appear in the statement of financial position is the profit that is being made, because profit will flow all the way down. Like in this case, Esco sold goods that cost him 8,000 to Pico at 10,000. So he has made a profit of 2,000. He has made a profit of 2,000. So from Pico, so he will be recognizing that profit in his books, right? And you know that profit will flow all the way to profit for the year. And when you have profit for the year, it goes to retained earnings. And retained earnings is usually sitting in the equity of statement of financial position. So that profit that is being made, that profit that is being made is a profit that needs to be eliminated, because it's not a profit that is made from outsiders. And that is why this sentence is extremely important. It says that, and these goods were still unsold by Pico. You see, if Pico has sold these goods, if he has sold these goods, those goods he bought from Esco, it therefore means that those profits, the profit that was made by Esco is now a profit that is earned from outsiders, because the goods are not even within the group. Pico has even made money from outside as well. So those profits would therefore be a profit that is earned economically by the group. That one would not need to be eliminated. So you need to always watch out for this. Again, we're looking at statement of financial position. That profit that is unrealized, that we have not realized, we need to eliminate it. And it is unrealized to the extent that the goods remains unsold. The goods remains within the group. However, when I teach you statement of profit or loss and we want to consolidate that, whether the goods have been sold out or not does not matter. There is still transaction between the parent and the subsidiary, and that has to be eliminated at the level of sales and purchases. All right. However, as far as the profit is concerned, right? As far as the profit is concerned in the retained earnings, in the statement of financial position, it's only to the extent that it is unrealized. It is only to the extent that the goods remain or is still sitting in any of the entities in the group. Then to that extent, it's unrealized and the group cannot say he has made money, that he has made profit. You cannot consolidate that because we want to see you guys as an economic unit. So that is one that has to be eliminated in this transaction. Now, the second one, like Balkis and Lekon mentioned, is inventory. You know that inventory will be sitting in the statement of financial position of the buyer, who is Pico. However, you can't cancel out inventory. If you want to cancel it out, against what? So the only thing you cancel out in that inventory is just the profit in that inventory, because the seller has sold those goods at a profit to the buyer. Like in this case now, Pico, he has not sold any of this. So he's carrying those goods in a statement of financial position at 10,000. That has a profit element of 2,000. And for the fact that this profit element is unrealized, it needs to be eliminated. So we would remove it from the inventory of Pico and also from the retained earnings of ESCO. And that is how it is treated. You have to understand it that way very well, the flow. Don't just cram, you remove it from inventory, you remove it from retained earnings. If they change the scenario for you, it becomes a problem. Okay, Moses, I can see your hand up.
Yeah, boss, sorry, I want to ask if it comes to group accounts, I don't know if they address transfer pricing issue. For instance, if you are transfer between themselves, probably they are selling to outsider at 200 naira, but within themselves, they transfer below that selling price. I don't know if group account address such issue.
Okay, so we don't account for that, right? For in consolidated statement of financial position, but it's required for especially the parent entity and even the subsidiary, to file transfer pricing declaration and disclosure with FIRS, with NRS. So, because that is where you're going to report all transactions with related parties. But we don't show that in our bookkeeping. We don't recognize that in our bookkeeping, but it's mandated that you file transfer pricing disclosures and declaration. Okay. So Alimat said I should take it again. So again, you know that we're doing statement of financial position. And the idea is that all transactions between the members of the group should not be consolidated. That is the idea of group account, especially consolidation. All transactions between the members of the group should not be consolidated. And this is a type of a transaction between members of a group. They sold goods to one another. So selling goods, ESCO will record this in P&L as revenue. PICO will record, ESCO will record 10,000 as sales. PICO will record 10,000 as purchases, right? So we cancel them out in P&L. So I was now asking then, what do we then cancel out in the statement of financial position? Is the profit that ESCO has made that will flow to retain earnings. So that profit would be cancelled out, but I said to the extent that it remains unrealized. Because if it has been realized, that is, and it can only be realized when the goods has been sold outside of the group. as soon as Pico sells this goods out to another person, that means that profit was not really made from Pico anymore. That profit was made to that person that Pico has now sold it to. So that profit then becomes realized, right? So you would not have to cancel that out. So in this case now, this good has not been sold by Pico. So we do not eliminate it. Even if they tell you that a portion of the good has been sold, that means you prorate. If they tell you 50% of the good has been sold, that means that 2,000 naira profit, only 50% of it is unrealized. Only 50% of it is unrealized. So you only eliminate that profit to the extent that it remains unrealized. And secondly, is the inventory that will be sitting in the books of Pico in the statement of financial position. You are not going to eliminate the entire inventory. No, that one is an asset of Pico. That one is an asset of Pico. What you eliminate is the profits loading in that inventory. This inventory of 10,000, there's a profit there of 2,000 that Pico has made. And to the extent that that profit remains unrealized, you need to eliminate it. So you would remove it. So the two legs is then complete. One, as far as the statement of financial position is concerned. So that's why I explained the H3 to you. You are going to eliminate it from the retained earnings of ESCO. You know, it's ESCO that made the profits. You would eliminate or remove it from the retained earnings of ESCO. And also, you are going to eliminate that same unrealized profits from the inventory of Pico. So, Alima, I need you to make a sign just to be sure that you understand what I'm saying.
Sorry, sir. I really don't understand yet.
Okay. Suliat. Okay, I'll come to you. But let me be sure. The person that asked it first. Alimat,
I
are you there?
understand, sir. I understand. Thank you.
Okay. So again, Suliat or Yetunde. So it's still the same thing I'll still say. We are trying to eliminate intra-group transactions between members of the group. And here we are preparing statement of financial position. And the only intra-group transaction here is that they sold goods to one another. These are recorded in P&L. But the only things that flow through to statement of financial position is the profit that ESCO is making. That profit will flow from gross profit all the way to profit for the year, all the way to retained earnings. That profit in retained earnings, as long as it remains unrealized, it should be eliminated. You have to remove it. It's not an economic profit as far as the group is concerned. But it can become realized if Pico or the other party that bought the good and sold it out to outsiders. It then become realized. Then you won't have to eliminate it. Even if it is a portion that was sold to outsider, it's only the portion that remain unsold. Okay, you're going to take that portion of the profits. That's the only portion you are going to eliminate. So you eliminate that unrealized profit from the retained earnings of ESCO. Also, in the inventory of Pico, remember it's Pico that bought the goods. He will be sitting in his inventory. He has not even sold it out, so it's in his inventory. But this inventory of 10,000, as you can see, includes a profit of 2,000. Because this guy made 2,000 for me. The cost of the goods is 8,000. That profit needs to be removed. we have to remove it. Otherwise, we will not be reflecting the group as an economic unit. So we eliminate that. So the two legs is that we're going to remove this unrealized profit from the retained earnings of the seller, in this case, ESCO, and also from the inventory of PICO. So you need to, as soon as you get this, that's all. You just, but I need you to understand it deep down, not surface cramming, surface understanding. So who else has not still understood it? Yetunde.
Sir, I understand already. Thank you.
Okay. Where is Fashion? Fashion is not here.
Please, boss, I wouldn't mind if you can re-explain, please. I
Okay,
just
no
joined not quite
problem.
long.
Okay, no problem. I can do that. Where is Fashion? Okay.
Our star boy is not in the classroom.
So so Moses, you have a lot of work on you today. Okay, so Anthony, what we are saying is this: we are trying to move further, and here we have a question where there was transaction between parent and subsidiaries, especially here it was a transaction of sales of goods. And the idea of consolidation is to ensure that we eliminate any transaction between the parent and the subsidiary. Any transaction between the two of them. They can't make income from themselves. That's the whole idea. Any income or expense they have incurred within one another, eliminate it. Any similar transactions between them, eliminate. Any item that is showing as asset in one place, liability in another place, remove it totally. So now the key transactions here is that they sold goods to one another. So this will have been recognized in the P&L of ESCO. It will recognize sales 10,000, PICO will recognize purchases 10,000. When I teach you P&L, you will see that I will eliminate that completely. But now I'm doing similar financial position. So the part of this transaction that flows to statement of financial position is the profit. Because ESCO has made a profit of 2,000. He sold at 10,000, good that cost him 8,000. That 2,000 goes all the way down to his retained earnings. You see, as long as that retained earnings, that profit of 2K remains unrealized, it cannot be consolidated. We need to remove it from the retained earnings of ESCO in the statement of financial position. When you're consolidating, you have to remove it. You will not only remove it if it has been realized. And it has only been realized if the buyer, in this case PICO, has sold the good out to outsiders. Then it has been realized. That means that profit is made from outsider. That is an economic profit. As far as the group is concerned, it's okay to consolidate that. But as long as PICO has not sold these goods, we do not consolidate that. It is an unrealized profit. So we remove it from the retained earnings of ESCO in the statement of financial position. Additionally, in the statement of financial position as well, you need to understand that PICO will be having this 10,000 as inventory in his books. You are not canceling out the whole of this inventory. No. Because where is the other assets leg? So you're not canceling out the whole of the inventory. What you're canceling out in this inventory is the retained earnings, is the unrealized profits, not the retained earnings, the unrealized profit in this 10,000, which is 2,000. So remove that 2,000 from the inventory of PICO. So two things. One, we remove the unrealized profits from the retained earnings of ESCO, and you remove it from the inventory of PICO. And that is how you deal with intra-group sales of goods at every point in time. So that is all. As far as this question is concerned, that is all. So, like I've explained, first, I dealt with the intra-group sales of goods. In this case, since the goods remain unsold, the unrealized profit is that 2,000 naira. And like I've explained, you are going to deduct it from the inventory of PICO, 2,000, and also from the retained earnings of ESCO, 2,000. Okay, that's all. Then other items to cancel out, that like we have always done, you're going to cancel out the investment against the net asset of the subsidiary. So the investment, the amount paid by the parent is 37,500, if you remember this. Okay. Then NCI, we're told NCI is measured at fair value. We're given the value of NCI as 12.5. Then we cancel that out against the equity or net assets of the subsidiary, which is this 50,000. So in this case, this 30,000 is totally post-acquisition retained earnings. Why is it totally post-acquisition retained earnings? Why is this 30,000 not pre? Why is it totally post? We can figure that out. Okay, Balkis.
Because it's since incorporation.
Thank you very much. Thank you very much. That's absolutely correct. So it's because we acquired the subsidiary since incorporation. Okay, since when it was just starting up, it wouldn't have made any profit as at then. So this profit you're seeing here was made after acquisition. So it is post-acquisition. So that has nothing to do with this. That has nothing to do with this. Okay. So by the time we cancel these two out, we don't have any balance. So that's fine. Then, as part of the workings we usually do, is we try to determine the consolidated retained earnings because it requires some adjustments to be made. And from the correction, meaning as at the year end, the retained earnings of the parent was 75,000, which is this. That of the subsidiary is 30,000, which is this. Remember, we said we should remove 2,000 unrealized profits from the retained earnings of ESCO. So we have to, which is part of the reason why we're doing these workings. So that has to be removed. So we'll be left with 28,000. And it is this 28,000 that would then be shared between the parents and the NCI. So I put it as group share. So the group is, which is, the group is taking 75% of the retained earnings of ESCO. So, which is 21,000. You add that to the retained earnings of the parent. So it brings it up to 96. Also, NCI as well, we consolidate it. We have already gotten its value as given in the question. So I usually take the value from here, from these workings here. You just pick it. That's the value of NCI. He would then also take his own share because he's a part owner of ESCO. He will take 25% of the profit of the post-acquisition retained earnings of the subsidiary, which is 7,000. So it brings him to 19.5. And those are the relevant workings that we do. Now, after doing that, we have done all relevant calculations. All is left is just to sum together. We sum these two together. While remembering to remove 2,000 from these guys because there's an unrealized profit there. We sum these two together. This 50,000 has been cancelled out, so we only consolidate this. We have done workings for this, so we also sum these two together. So all the other things are quite straightforward, which is what we showed here. So we have PP, the addition of the parent and subsidiary, inventory, the addition of the parent and the subsidiary, while remembering to remove the unrealized profit of 2,000. Receivables, the addition of the parent and subsidiary, we have a total asset of 187,500. The ordinary share capital is that of the parent because that of the subsidiary has been cancelled out. Then the consolidated retained earnings from our workings 3 was 96,000. Non-controlling interest from our workings is 19,500. And always remember that NCI is seen as part of equity because it's not a liability. It's a part owner of the subsidiary. So we will put it as part of equity. It's 19,500 from our workings. Altogether is 155,500. And current liabilities is 32,000. The addition of rent and subsidiary. So we have this. So that's that. Now, another question very similar to the one we did up there is also this. This one says that Pico acquired 80% of the shares of ESCO on 1st January 2017 when the retained earnings of ESCO stood at 5,000. The statement of financial position of the two companies on 24 December 2017 were as given below. Given similar financial position as at 34 December 2017. So of the two entities, we're now told that during the year, ESCO sold goods to Pico for 25,000. The profit to ESCO being 20% of selling price at the end of the reporting period. 7,500 of these goods remain unsold in the inventories of Pico. At the same date, Pico owed ESCO 6,000 for goods bought, and this debt is included in the trade payables of Pico and in the receivables of ESCO. NCI is valued at 9,000. Again, the focus is cancelling out similar transactions between the parent and the group. Here, from the beginning, we're given the retained earnings of ESCO at the date of acquisition, which we are now used to calling pre-acquisition retained earnings. This has to be cancelled out. And we're given the similar financial position of the two. I know that these investments and this equity, ordinary shares plus pre-acquisition retained earnings, needs to be cancelled out. So I need to cancel out those ones. Additionally, the ESCO sold goods to Pico for 25,000. Now, in this case, they gave us the profit it made as a percentage of selling price. Okay, unlike the other one, where they gave us the profit in absolute amounts. Here we're given in percentage. Now, this profit, is there anybody that can tell me? Because when they give you profit in percentage, is either you call that profit margin or markup. Is there anybody in this class that can identify whether this 20% is margin or markup? Anyone?
Margin.
It's margin, sir.
Absolutely correct, Jamie.
Because of selling price was mentioned.
Yes. So it's margin. So, and in other instance, the examiner would say that the profits, or they will tell you that the seller usually sells at cost plus 20%. Okay? If they say cost plus 20%, since cost was mentioned, that means that 20% will be a markup. That 20% will be a markup in that instance. So we would see how that is treated as well, but not to worry, they are actually straightforward. So in this case, since this profit is as a percentage of selling price, so to easily get the profit is not difficult. You can all guess that the profit ESCO made is 20% of 25,000. Okay, it's 20% of 25,000, which is 5,000. And what do we do with these profits? We eliminate it. We eliminate it from the retained earnings of ESCO and from the inventory of PICO. But wait. He said at the end of the reporting period, 7,500 of these goods remain unsold. It means that out of the 25,000 worth of goods, this guy has sold a lot, that only 7,500 remained unsold. That therefore means that it's not the entire 5,000 profits that was made by ESCO that is unrealized. A huge percentage of it is realized. What we need to eliminate is the unrealized portion. And it's simple. Since 7,500 is unsold and 25,000 is the total worth of the goods, just do 7,500 divided by 25,000 multiplied by 5,000. That gives you the portion of the profits that is unrealized. It is that portion that is unrealized that you're going to take out from your retained earnings and also from your inventory. Alternatively, if you do 20% of 7,500, it should give you the same answer, which is more straightforward, which is better. But I need you to understand the two, just so that you are not in the position of cramming anything. So let's try it. If you do 7,500 divided by 25,000 times 5,000, it gives us 1.5. If you do 20% times 7,500, it gives us 1.5. Choose your easier. Choose whatever the one you feel is easier for you. Now, we're told that at the same date, PICO owed 6,000 for goods bought, and this debt is included in the trade payables and receivables of the two. It has to be eliminated since it's appearing as an asset in the books of one and as a liability in the books of another. This has to be cancelled out. And also, we're told that NCI is valued at I deleted something. Oh. How did they value NCI? NCI. Okay, I think they gave us at 9,000 at the date of acquisition. Okay, so let me do my workings for all I've explained so far. So first, I chose the easy parts. To get my unrealized profit, I just did 20% of the unsold goods because I know that is the only portion where the unrealized profit is sitting. That's the only inventory remaining within the group. So I chose that. I got my 1.5. I deducted it from inventory of PICO. I deducted it from retained earnings of ESCO. That's all that needs to be cancelled and needs working. This one does not need any working. This is 6,000. The other one that needs working is cancelling out this investment against net assets. This 23,000 investment. And I show that. So I show that here. Now I pay 23,000. That's the money the parent paid. That's money the parent paid. Then I added NCI that was valued at 9,000. Then you add the two, gives 32,000. You cancel this out against the net asset of the subsidiary. The share capital of the subsidiary is 15,000. we're given the retained earnings, the pre-acquisition retained earnings, if you remember, of this. Yeah, canceling it out against it of 5,000. So the addition of the two gives 20,000. Compared to this 32, you're having 12,000, which we call goodwill. Furthermore, we are going to do workings for our consolidated retained earnings. You always have to do workings for this. It's automatic. Immediately after goodwill, you will need to do workings for these retained earnings because of the things you are deducting and adding and all that. So at the year end, the retained earnings of PICO is 22,500. That of ESCO is 11,000. Out of this 11,000, we have cancelled out the pre-acquisition retained earnings of 5,000, remaining 6,000. And this 6,000, remember, there was unrealized profits that was made by ESCO that we need to eliminate of 1,500, remaining 4,500. This 4,500 will share it between parent and NCI. Parent has a holding of 80%. Is it 80%? Yeah, 80%. Parent has a holding of 80%, so he gets 80% of retained earnings of ESCO, which is 36. So I add it together with this to give me 26,1. And NCI, value of NCI is 9,000. And the NCI will get 20% share of this 4,500, so which is 900. So add it together, we get 99. Then the others is just very straightforward. PPE, you just adding together parent and subsidiaries PPE. Goodwill from our workings, 12,000 from our workings 2, I guess. Then for current assets, first, we're going to remove the unrealized profit from inventory. And we're going to remove these 6,000 receivables, the intra-group receivables. So it leaves us to 27,500. And you know that this 35,000 is the addition of the parent and subsidiaries current asset. By the time we remove all that, you are left with this. So we have 99,500. Then the equity, the ordinary share capital is that of the parent because that of the subsidiary has been cancelled out. The consolidated retained earnings has worked in workings 3. The NCI in workings 4. Then my current liabilities, I need to deduct that intra-group receivables and payables of 6,000, which I also deducted from here because they're intra-group. I'm left with this. Then I have a total of 99,500. And that is that. So it's just majorly the profits we are eliminated. Now, let's look at another one. It says PICO acquired 80% of the shares of ESCO on 4th January 2016 when the retained earnings of ESCO stood at 5,000. This clearly is pre-acquisition retained earnings that will be cancelled out. The statement of financial position of the two companies on 31st December 2017 are given below. So we're given the statement of financial position of the two entities. Now, it said on 4th January 2017, ESCO sold plants costing 5,000 to PICO for 6,250. The group charged a depreciation of 10% on all non-current assets. NCI is valued at 9,000. Okay. Prepare consolidation of financial position at the end. So here, in addition to these investments that needs to be cancelled out against the equity of the subsidiary, there was also transactions between the parent and the subsidiary involving sales of plants. Now, this one is very similar to sales of goods because there will be profits made that needs to be eliminated in the statement of financial position. But now, since it was assets that was sold, okay, since it was asset that was sold, that means one party will have that asset in his books, and in this case, PICO, he will have it in his books as a profit loading. Okay. So as we are removing the unrealized profits in the retained earnings of ESCO, because he has made a profit of 1,250, okay, which is going to flow down to, and you know, this sales that he made is a disposal. He will have made a profit on disposal that will go to P&L, okay, and will flow up to all the way to retained earnings, similar to what I've explained earlier. So that's why we are removing it from its retained earnings in the statement of financial position. We'd also remove that 1,250 from the plants of ESCO, of PICO, right? Because it's carrying it at a profit loading that is unrealized. The group hasn't make any, you can't make profit from yourself. It's not an economic profit. So we remove it. However, because this is plants, is PPE, they will have charged depreciation on it. And PICO will have charged depreciation on 6,250. And now that we are eliminating that profit, so that means there is an excess depreciation that PICO has already charged. We need to reverse it. We need to reverse that excess depreciation that PICO has charged. Now, let me ask you again. Let me joggle your mind. Who can tell me the excess depreciation, the over depreciation that PICO has charged that needs to be eliminated? Who can figure that out?
Hello, sir.
Yeah, Moses.
Yeah, I think the excess depreciation must have been accrued and in his profit or loss account. It would have credit is accumulated depreciation and debit is profit or loss account. Now,
And
since he said,
before we get there, how much? I need to know how much first.
okay, the amount, okay.
25.
Thank you very much. Is that Shidera? It's 125. That's perfectly correct. 125. So because the profit load here is 1,250. So the extra amount that should not be here is 1,250. So just take 10% of that. Since the group depreciation, the depreciation charge by all members of the group is 10%. So he has charged 10% on an extra 1,250. So which is 125. And that's the excess depreciation. There are other ways of doing it, which is longer. Let me not even see that. So just 10% on the unrealized profits will give you the excess depreciation that needs to be eliminated. Now, let's now go to what Moses was trying to answer. So how do we remove this excess? How do we, in fact, what we are doing is not even removing, we are reversing it. That you have charged this, you should not charge it. So how do we reverse it?
In the book of
Anybody?
PCO, we're going to debit accum dip and credit depreciation.
In the book of the parents. Okay. That's correct. That's correct. But you didn't bring it to the level of, you are correct. Okay, because he just did the reverse of what the parents will have how they recognize. You know, the way you recognize depreciation, you debit P&L, and you credit accumulated depreciation. But now for us to reverse it, you're going to credit P&L and debit accumulated depreciation. However, if you want to bring this to what we are doing now, statement of financial position, you know that P&L that he has debited with depreciation, right? He will have reduced his profits. This will have reduced his profit and will have flown to, that reduction will have flown to retained earnings, right? So to reverse that, we are going to credit the retained earnings of PICO without excess depreciation. We credit the retained earnings of PICO without excess depreciation. And we can then say we debit accumulated depreciation, right? Since they will not give you that separately, just debit these assets. Since it has already factored in accumulated depreciation, you debit it to reverse that depreciation. Okay? So since we are doing statement of financial position, we cannot adjust P&L. It only retained earnings that will have been impacted in statement of financial position. So you credit that, and crediting means you are adding it. You're adding it to it. So let's do that. So first is the sales of plants. The subsidiary has made a profit of 1,250. This profit, we're going to take it away from the plants of PICO because PICO is carrying this 6,250 in his assets at a profit load. And we are going to remove it from the retained earnings of ESCO as well. Also, they have overcharged depreciation, call that excess depreciation, which is 10% of the unrealized profits, which is 125. Or you can do a longer way, that the depreciation is charged is 625. The depreciation they should have charged is 500. So there's excess. Don't do this. It's too long. Do this instead. It's better. So we're going to add this to the plant of PICO because he has over deducted depreciation from the plant. So you add it to the plant through the accumulated depreciation. Then you are also going to add it back to the retained earnings of PICO. That's how you adjust for that excess depreciation. And we have corrected all the anomaly. Those are the consolidated adjustments. We have eliminated the unrealized profits. We have reversed the excess depreciation. Then the investment in the subsidiary, we cancel that out as well. We invested 23,000. The value of the NCI is 9,000, bringing a total of 32,000. The share capital of the subsidiary is 15,000. Pre-acquisition retained earnings of the subsidiary is 5,000. Altogether 20,000. So we have an excess of 12,000, which we call goodwill. Our retained earnings. So as per the correction, retained earnings of PICO is 22,500. That of the subsidiary is 11,000. Out of this, we remove the pre-acquisition retained earnings so that we are left with the posts. And don't forget, there was an unrealized profits in the books of ESCO that we said we should remove. This one that we said we should deduct from ESCO's retained earnings. That profit he made. So we remove this, left with 4,750, which will be shared between the parent and the NCI. Before then, parent also charged an excess depreciation of 125, which we are reversing by adding it back to his retained earnings. So he also get a share of the retained earnings of the subsidiary, which is 80% of that. That gives us 38. We sum it together, we have 26,425. And finally is non-controlling interest. We get the value of NCI which is 9,000, which is we picked it from here. Then it gets a share of profit of the subsidiary, which is 20% of 4,750. So totaling 9,950. That's all. Then we can consolidate. Then in consolidating, we'll add together parents' PPEs while ensuring to remove the unrealized profit and adding back the excess depreciation. We bring in our goodwill as computed, current assets, then we have our total assets. Then under the equity and liabilities, we have the ordinary share capital, which is that of the parent alone, because that of the subsidiary has been cancelled out. The consolidated retained earnings from our workings up in workings 4, the NCI in workings 4. Then we add together current liabilities of the parent and the subsidiary. Then it gives us a balanced figure. And that's that. So nothing is really changing much. All we are doing is just canceling out similar transactions, making sure that we do not recognize profit that are made between the parent and its subsidiaries. You cancel all of that out, and any other leftovers are reversed. Now, this one says that Pico acquired 80% of the shares of ESCO on 1st April 2017. On December 2016, ESCO accounts
Hello,
showed a
sir.
share
Sorry
premium.
for putting you back. This last one, I don't understand. I can't lie. This last one that you just saw.
Um, that's a vague response, right? You need to ask that better by saying, I don't understand this and this. You can't just say you don't understand. Which one exactly? Here today we are waiting. Like over 30 people are waiting for you.
Sorry. I know you. What did you say?
Which one is it you don't understand? You can't just say you don't understand. Is it that you're not listening to it at all? Which one? It will
I
be a
am.
point. So which one is
The
it you
from
don't
the
understand?
part of the goodwill is what I'm talking about.
Goodwill, okay. This
This
one.
this side downward. Yeah.
What is it you don't understand? Well, this one is just things we have been doing over and over again. There's nothing new here. So is it the unrealized profits that I deducted from ESCO, which I've explained up here, that we remove unrealized profit from the books of ESCO? I deduct from the books of ESCO, which is what I've done, and whatever balance is shared between the two. The excess depreciation, I've already mentioned it here, that you add it back to the retained earnings of PICO, which is what we did here. We added it back, and it got its own share of the retained earnings of ESCO. That's it. All of these ones, I've been doing it over and over again. Goodwill, consolidated retained earnings, and all that. The major thing here is this. And if you understand this, I don't think you have a problem. I think you're fine, because this is the new thing here.
All right. All right. Thank you.
PICO acquired 80% of the shares of ESCO on 1st April 2017. On 31st December 2016, ESCO's account showed a share premium account of 2,000 and retained earnings of 75. The statement of financial position of the two companies on 31st December 2017 are given below. NCI should be valued at full value. The market price of the subsidiary shares was 3 naira prior to acquisition by parent. We're given the statement of financial position of the two entities, and we're asked to prepare consolidated statement of financial position. Okay. So here again, there's nothing much. There's nothing here. I think what we have been doing before is we are going to cancel out this investment against the equity of the subsidiary. But in addition to that, is this what I can see here is that we acquired the subsidiary during the year. We acquired the subsidiary in April, and the year end is December. Okay. So what then becomes a challenge for us here? Well, let me ask this. What is the retained earnings of the subsidiary at the date of acquisition? Who can tell me that? What's the retained earnings of the subsidiary at the date of acquisition? Okay, Lekon, you can go first, Lekon.
I guess we will add the share premium 2,000 to the retained earnings 75.
Okay, so this share premium too is a pre-reserve that would cancel out as well. Yeah, but this retained earnings of 75 also is a pre-retained earnings, which will also cancel out, but that's not correct. In fact, let me help a little bit better. That is not all the pre-acquisition retained earnings. That is not all the retained earnings at the date of acquisition. These are retained earnings prior to the date of acquisition in December, which is okay. But you need to understand the fact that the subsidiary might have also made some profit between January and March. That should also be part of that's also a That's also a pre-retained earnings that should be cancelled out as well. It's part of what the parent will pay for. So it's not this. Is in addition to this, there are other amounts. Yetunde, can you try? Where can we get the 3 months profits, which is also pre that we're going to add to this? Yetunde,
Sir?
so you should try.
Mm.
Okay, while you're thinking, Sharafa, please go ahead.
The retained earning that will belong to the parent company at the end of the year will now be 9 months. Then why the remaining 3 months will belong to pre-acquisition retained earning.
So how do you get that?
I mean 3 divided by 12 multiplied by retained earning at the end of the year for the subsidiary.
No. You're almost there. You cannot do 3/12 times the retained earnings at the end of the year. You cannot do it because that retained earnings at the end of the year includes this one.
Okay, sir. No, yeah, I will first of all remove those one from it first. The premium and the retained earning, you remove it from the total retained earning. Then the balance now will now be 3 divided by 12 multiplied by the balance. Then you now add it to those one. That will now serve as pre-acquisition retained earning.
But you are not removing premium from retained earnings, so premium is different from this premium. Premium has not even changed. It's 2,000. It was 2,000 in December. It's still 2,000.
You are right. I didn't check that area. You are right, sir.
Yes. So that's the correct position. That's the correct position. So it's logical, right? We acquired this subsidiary in April, right? The year end is December. So the only thing this question wants to teach you is when you acquire a subsidiary during the year, you have to carefully determine the retained earnings as at that date. Don't rely on the retained earnings on the year end, on the prior year end. Yes, it's correct, but that's not all. The subsidiary will have made some profit between that till when we acquired them during the year. In this case, 3 months. And the only way to determine that is this 19.5 at the end of the year. This is the retained earnings as at December 2017. It includes this. So what I need is, what's my profit for the year? The profit from January 2017 to December 2017 is just this 19.5 minus 7.5. That will give me the profit he has made for this year. I just take 3/12 of that. That is the pre. That's the pre. And like Moses said, that's when we add to this to get the retained earnings as at this date. As at this date. That's the only thing this
Absolutely
question
correct.
wants to, yeah. That's the only thing this question wants to teach you. Okay. So, which is what I've shown here. We want to get the pre-acquisition retained earnings as at April 2017. So we were given the retained earnings as at December, which is 7.5. We need to get a profit for the year, which is 12,000, 19.5 minus 7.5. We need to get a profit for 3 months, which is 3/12 times 12,000, which is the profit of January to end of March or 1st of April. And that's 3,000, which we're going to add to this 7.5. So altogether, we have 10,500 as our pre-acquisition retained earnings. And that's really working. So now we can do what we have been doing all along, cancellation. So the consideration transferred, which is 25,000, this 25,000 plus the value of NCI. We're told here, they didn't give us value of NCI here. We're told NCI is valued at full fair value, and it gave us the market price of the subsidiary. So we'll just multiply the holding of the NCI by the market price of the subsidiary. So since NCI has 20%, okay, we'll just do 20% multiplied by how many shares does the subsidiary has? You can tell me. How many shares does the subsidiary has? How many shares?
10,000 units.
Thank you very much, Alpha. Thank you very much. Which is 5,000 naira divided by 0.5. So you have to be very careful here. So they intentionally want to trap you because they know you will need number of shares. Ordinarily, they will have given you the nominal value as 1 naira, like usual. So some people will just go and multiply 20% by 5,000 or straight. You'll be wrong. Okay, so you need to carefully get the number of shares, which is usually 5,000 divided by the nominal value. In this case, 0.5. That will give you 10,000 shares. Okay, and that's what we did here. We did 20% times 10,000 shares. These shares multiplied by the share price of the subsidiary. So that gives me 6,000. That gives you 6,000. So altogether we have 31,000. Altogether we have 31,000. So we get our net asset acquired, which is the ordinary shares of the subsidiary, which is 5,000. The pre-acquisition retained earnings, which is 2,000. I'm sure you understand the fact that this share premium is a pre-acquisition because it has been there before acquisition. As at 2016, it was 2,000. As at 2017, it remains 2,000. So it has been there. It's a pre-acquisition reserve. We'll cancel it out. So it's 2,000. And as we computed up there, we have 10,500 pre-acquisition retained earnings. 10,500. So if you add these three together, you get 17.5. So we have a goodwill of 13.5. So our retained earnings, as at the year end, the retained earnings of Pico is 20,000. That of Esco is 19.5. If you take out the pre-acquisition retained earnings of 10.5 as computed, you are left with 9,000. So this 9,000 can then be shared between the parents and the NCI. So the parent will take 80% of this 9,000, which is 7,200. So you add it to this 20,000. So we get 27,200. So NCI, value of the NCI, I usually just pick it from what I computed up here. He will get his own share too of these 9,000, which is 20%. So totaling 7,800. And the others is just adding together figures. So 31,000. Goodwill as picked from our workings, current asset. Share capital of the parent, share premium of the parent, from our workings, parent and subsidiary added together, then we have a balanced figure. So the only principle this one is teaching you is when we acquire a subsidiary during the year, you need to work out the retained earnings as at that date. Now, another principle. This talks about Pico acquired 80% of the ordinary shares of Esco on 1st April 2017. At that date, the fair value of Esco's non-current asset was 11.5, greater than their carrying amount. And the balance of retained earnings was 10.5. Statement of financial position of the two companies on 31st December 2018 are given below. NCI should be valued at full value, which was deemed to be 18,000 at the acquisition date. So we're given statement of financial position of the two companies. He said if Esco had revalued its non-current assets on 1st April 2017, an addition of 1.5 will have been made to the depreciation charge for the year March 2018. Okay, now let's look at this together. Again, we acquired the subsidiary in April, okay, which is not during the year because the year end is March. So at that date, the fair value of Esco's non-current asset was 11,005 greater than their carrying amounts. So what we are saying is this: the non-current assets, which is, let's say this PP of 14,000, okay, is understated, meaning the fair value is actually 11.5 higher. 11.5 higher. So it means that the fair value of this guy's figure should be much higher than this 14,500. That's what they are telling us here. So what do we really need to do with this? What we need to do with this is to update the subsidiary's value. So us to update it. And I've taught you this. So who can tell me, how do I recognize this? Or what name do you call this 11.5? Under what I've taught you before. What name do you call this 11.5? I hear you.
Revaluation.
Surplus.
Thank you very much. Revaluation surplus. And how do you deal with revaluation surplus? What's the double entry for revaluation surplus?
You debit the asset, you credit retained earnings.
Why retained earnings? It's not retained earnings you credit.
Evaluation, sir.
Because it's okay.
You credit OCI or revaluation. Yeah, that's correct. You credit revaluation. That's the double entry. And that's what we need to do in the books of this guy. We need to pass that adjustment. So debit his assets so that his assets will go up from this 14,000. It will go up by this. Okay? To go up by this. And we would credit revaluation reserve. However, since this is done, this adjustment is being done at the date of acquisition. Now, that reserve, is it going to be a pre-acquisition reserve or a post-acquisition reserve? That evaluation reserve, who can think that out? Will it be a pre or a post, and why? Okay, nobody. It is a pre-acquisition reserve. Any reserve at the date of acquisition is pre. Okay. And this 11.5 is not just coming up at that. It's something that has been with the assets. We are just doing the valuation at the date of, so they say at that date. So it's at the date of acquisition of the subsidiary. That was when they did the value, but the value wasn't just happening then. It must have been part of the asset, just that they didn't know. So they did the valuation at that date. So it is a pre-acquisition reserve. So, and do you know what we do to pre-acquisition reserve? We cancel them out, okay? It's not something that parent and NCI will share. It's something they paid for. It's an intra-group transaction that needs to be canceled out. So we're going to cancel that out on consolidation. And how do we do that? It's just the normal way we usually cancel out, which I'm going to show you very soon. Additionally, this 11.5 now that the subsidiary did not incorporate, it means that it would have undercharged depreciation. You know, we have looked at excess depreciation when the asset has profit load. In this case now, the asset was understated, meaning you will have understated depreciation. So we need to incorporate it. And this one will now record it the way we record depreciation normally, which is P&L and accumulated depreciation. But here now, we are doing statement of financial position. So the one that goes to P&L will impact retained earnings. So we are going to deduct it from the retained earnings of the subsidiary. And also, we are going to deduct it from the asset of the subsidiary, the under depreciation. So let me show you how that is done. In fact, they already computed it for us as 1.5. They said if ESCO had revalued its non-current assets as at this date, an addition of 1.5 will have been made to depreciation charge at the end of the year. So this is the under depreciation that we need to. Okay. So like I've explained to you, there's a revaluation surplus of 11.5, which we are going to add to PPE and add to pre-acquisition revaluation surplus. And there was an under depreciation. We'll deduct from PPE of ESCO and deduct from retained earnings of ESCO. Goodwill, the money the parent paid, 25.5. Let me show you. 25.5. The value of NCI, 18,000. Let me show you. 18,000. We're given the value straight on. Then we would cancel it out against the net asset acquired, which is share capital plus pre-acquisition retained earnings, which they gave us. Let me show you. 10.5. And also the revaluation surplus pre, which is this one that we said you treat as a pre-acquisition revaluation surplus. So add together it gives 32,000. So we're having a goodwill of 11.5. This 11.5 and 11.5 is coincidence. So don't think that is the good. It's just a coincidence. So retained earnings, as we always do, at the end, retained earnings of the parent 48,000, of the subsidiary 20,500. Pre-acquisition retained earnings 10.5. so that we can cancel it out. Don't go and deduct evaluation surplus. So evaluation surplus is a separate, it's not the same thing as 10, and it's not inside this 25. Oh. So there's a balance of 10,000 as post. Then the depreciation, it did not charge, so we remove it, left with 8,005, which we are going to share between the parent and NCI. So parent gets 6,008, which is 80% of that 85. Then totaling 554,800, which is addition of this 48 and 68. The NCI, value of NCI 18,000, you get a share of the retained earnings of the subsidiary, which is 17. So we have 19.7. And that's all. Then we consolidate by adding the two figures together. PPE, after you have added the parent and subsidiaries PPE together, don't forget to add the revaluation surplus and remove the depreciation. Goodwill from our workings, current asset, addition of the two. Then share capital, that of the parent alone, because that of the subsidiary has been cancelled out. Retained earnings from our workings, NCI from our workings, our current liabilities, addition of the two, then we have a balanced figure. So that is that. That's really the end of statement of financial position. So what we have left is statement of profit or loss, as well as associates. Those ones are actually relatively short. They're actually very short. And I hope to finish it in the evening. So I have some practice questions here, right? I would share them with you. I would advise you to solve it yourself before you look at the solution. Is all the things that I've explained, everything that we have done. So I just put them in one place and I've put the solution inside here for you, just so that you can practice them together. So as I told you earlier, I'm going for a program. It's supposed to start by 1 so I just had to have this class because we have missed a lot. We should be done with group account by now based on my plan. But we plan, and God is the master planner. So so we need to re-strategize. So I have to go. So in the evening, we're going to come. When I'm meeting you in the evening, I know none of you is having any class today. I'll be starting with investment in associates in the evening. And I expect that you will have revised, you will have solved all these questions. So the first thing we will do is for us to discuss. I don't mind if I don't finish everything. I just want to be sure that you have actually looked at all of this. Because very like 2 or 3% of you do assignments. Maybe those are the people that submit, but most of you don't come back with most of you. Very few usually come back at all. So we'll discuss this in class. I can call on any of you to explain anything to me, any additional information, and tell me how it is adjusted and all that. Then before I move to associate in the evening. And mark you, we lost 5 hours class last weekend. We need to claim it back. And the only time we have to claim it back is this weekend that we have. And we are going to start claiming it back from next week, Sunday. So again, we are going to be having, so I just need you to have this at the back of your mind and get ready. And because we need to claim it back, it's very important. We're going to be having 3 periods on Sunday. We're going to start our class from 11 to 1. We're going to I will allow you to go for break, to go and revise. We'll do another one from around 4 to 6. I'll allow you to go for break. Then we'll do the last one from the normal evening one that we do in the evening. So we'll have claimed back some 2 hours. Then we'll also find a way to claim back the other one as well, so that we can meet our target. Otherwise, we will not. So I'll stop here for now. I'll see you guys when I return back from where I'm going.
Yeah, sorry, sir.
Sorry, Wasiu. What time are we meeting back?
Let's do 9 o'clock in the evening.
Okay, 9. Okay. All right.
Sir,
Yeah.
sorry, you help us drop this note. Then secondly, I have a question in the area of revenue recognition. So if
Okay.
you are working in security, we provide security for people. So now from my end now, I recognize the entire money we receive from those clients as revenue. But some people are saying no, the revenue has to be a commission we charge on those guard. So I want to know which one is correct. Is it the entire money we collect from the client or the commission we charge as our revenue?
Is your commission? Is your commission? Is your commission? So it's an arguable area, but there are a lot of things that need to be looked at before we make that conclusion. But I mean, for now, just take it as your commission, because there are instances where we would even end up and saying that you need to recognize the whole amount as your revenue. But in most cases,
yes, I've been trying to see if I can use the commission. But at the end of the day, the management keep on asking me, can we see the receivable? And most of those receivable are those money, those clients are owing us regarding the guard we provided for them. So if you are saying we should use only commission now, and the receivable is even higher than what you claim as a sales, so the argument is coming from that angle.
okay, we'll look at it. We'll look at it later, Moses. So let me also think about it. So I have to go now, but we'll look at it. Don't worry.
All right. It's okay, sir. It's okay, sir. Thank you.
You're welcome.